Okay, so let's go through class problem 17-2. This is James and Sandra Culver. Okay, as we talked about, we took some of the stuff out of there because we'll kind of come back to it. Some of these problems we'll come back to as we broaden what our repertoire of skills is, I guess would be a good word for it. Okay, so we have James. All right. Okay. All right, so on the main info sheet we have oops. Remember, all capitals just because down the road it's going to pay off. All right, we have James and we had Sandra. All right. They're living at 1234 Union Road. How am I doing so far? Everybody in agreement? No problems yet? Okay, good. And two, as I talked about, make sure we're putting that email in, because it'll be very important when you get in the offices, because the IRS has allowed us the capability of sending emails of returns. We cannot fax them, but we can email them as long as we have it on file. Okay, we got date 12/15/63, and his wife is 8/12/63. Okay, they are teacher and a computer programmer. Okay, they're doing a married filing joint return. We have a couple rugrats here. We got Anna and her date of birth is 12/12/2004. We got a social security number for her. As you notice, as I do this, you know, I'm kind of going through my little test to see if she qualifies. Okay, my child tax credit hasn't lit up yet. Okay, so I have to keep answering my questions. I got relationship now, social security number, I got age in, I have residency, and this proves that she lives with me. So then my child tax credit lit up at the very end. Okay.
You have a text message.
All right. Okay, and we got a son. Okay. That lived with us all 12 months. Going to go ahead and check. Always check your earned income credit, whether you know they're going to qualify or not. In this case, we do have some dependent care, as it says on there, and check the box, but we won't jump into that one yet. Okay. They lived in New York all year long. All right. We're going to electronically file it. They're not doing the fee collect. We got some bank information here. Okay. All right. Let's see, they got PIN numbers because they're electronically filing it. And his wife picked a PIN number. Yeah, PIN numbers, you know, aren't unique in any way. They're just kind of their electronic signature. Okay. All right. Okay. It says on here that they filed a 1040 last year and they itemized. Okay. So that means that our question here in the middle, did you itemize? We're going to say yes. Okay. they received a tax refund of $421 from the state, but they also got the Empire Child Tax Credit in the amount of $660. So what's that tell me about the refund? Not taxable, exactly, okay? So that one's not taxable, so we don't have to worry about that. We got their refund into the, if they owe any, they will send a check. You got the information on the sheet. They were, neither James nor Sandra was a full-time student. EIC was not disallowed. We had that they all had health care. Must have been through James's jobs, so we can just check off the boxes that no from the marketplace, no for an exemption, and that they had insurance all year long. Okay. And James coaches sports where he teaches. The employer gave him a 1099 miscellaneous for coaching job. He logged 1,200 miles. Doesn't say anything about reimbursement. He drove his car, which he purchased in February 2010. He also had to buy some athletic equipment for $511.34, which was not reimbursed for any expenses. Okay, so we'll come back to that in a second. We had a W-2, and this is for James. All right, and the address matched on there. We're going to put his employer ID number in there. Okay, he worked for Hamburg Central School. You're on Main Street. All right, he had wages of, okay. Do anybody notice what happened with the wage thing in here? The auto calculation on it? Okay, so if I put in the 50321, okay, and I had withholding of 3678, all right, you kind of look and going, they don't match. Okay, he had a retirement plan. Here's that 414 something that comes into play, as you see in box 14 on his W-2. Okay, so he contributed $4,666 there, okay? Mm-hmm.
Didn't you up higher on the W-2? Didn't you have to click on that one line that says?
Mm-hmm. I'm gonna show you here in a second. Yep. Okay. So, all right. Typically what will happen is when you enter a retirement thing like this, if you enter it over here in box 12 with a D, it'll adjust these two guys. Okay, all right. So box 3 and box 5 will typically be automatically adjusted for retirement accounts when you put a letter D in. In this case, because it's in that miscellaneous box 14, what we're going to do, as Michelle was pointing out there, you're going to go up, see where it says check to take calculations off of lines 3, 4, 5, and 6. If you check that box, it'll allow you to edit the numbers in 3, 4, 5, and 6. So to match up to our W-2, because by right, his Social Security income should be higher, and so should his Social Security withholding. And the Medicare wages will be there too. And that should be $54,987. Medicare and Social Security are different? Yes. Mm-hmm. Yep. They match. Yeah, they should match. And then make sure we get our New York down at the bottom. All right. Okay. So we have that in there. All right. Everybody see how I did that? Because typically, like I said, if you have retirement income, you know, that's where they say pre-tax dollars. Okay. So if it's reducing it, you know, what would show up on your pay stub, but you can see that his income was less by what he was contributing to the 414H, but it doesn't calculate it up there, all right? If I took, okay, we'll show you on a different one. Okay, so we have his W-2 in there, all right? He had some miscellaneous income. So this is his little, they will have the miscellaneous income. Okay. All right. So we have the miscellaneous income here. All right, so we have that. And this is where he has a little job on the side that they talked about. So we're going to use that Schedule CEZ. Remember, we're just going to use that for right now. Okay. And this is for James. Okay. All right. Okay. And we have a 1099 miscellaneous here. Okay. So, and this is from, again, it's from Hamburg Schools, but it's his little side job. Just the way it is. It just may be the case that it is. Sometimes some companies might have something that's set up different, so. But we have to go with what's on the document there. All right, and he received non-employee compensation of $6,000, okay? So we have a $6,000. So let's go back to the Schedule CEZ. Our $6,000 is there. Now, if we go back to the little part with the log 1,200 miles, okay? All right. So the 1,200 miles, we can see business miles down below, 1,200. All right. And that was that, okay? But what does it has our standard rate. It says include this amount with any other expenses you list on line 2 above. Well, what do we know his other expenses were? Yep, so we're gonna go in here, we're gonna hit F5. So I got his 511.34, and I'm gonna add his 690 to that so that I can get his 1201 as far as his expenses. Everybody see how I did that? On the CEZ, the little 690 does not carry up above, okay? So when you get the miles, we're calculating the business miles, and they get 57.5 in 2015, that 690 does not come up here automatically. On the Schedule C, that's why I teach everybody to use the Schedule C when they're gonna do business expenses down the road, because you check a box and then it carries up for you. This one you have to manually go up and add it on that line. All right? Okay. So I have that. All right. Okay, and then the questions down below, was the vehicle available for off-duty hours? If it's his personal car, yes. He's married, we're assuming his wife has a car. Do you have evidence to support this? Yes, and obviously it's in writing because he brought it to us. All right. Okay. All right, so everybody sees how that works?
I'm sorry, under gross receipts, what do you have again?
For gross receipts, the 6,000 off the 1099 miscellaneous. For which one? The expenses. Yeah, did everybody get the expenses in there?
So what's the expense?
Well, the expenses, so did everybody get that in there on the Schedule C? Okay. Everybody got that? And again, don't get hung up on it, because when I do business income in about a week, I'm going to tell you to forget everything you just learned on the Schedule EZ. Right now, it's just an easy way for us to calculate with profits. Okay. Schedule C is much better because you'll have all those questions, you'll have different areas. You know, as is with the easy form, because we have, you know, lower, we're showing a profit and our expenses are less, you know, our little disclaimer questions is that's the top of this form. It's easy because it's then just a little 3-line. But just as you're finding with the Schedule CEZ, everything's manual. So it's good right now that you understand what makes up expenses and that you add them together and see how they're calculated. But for functionality, I guess would be a better word. For functionality, using the Schedule C is much better, okay? Because that whole mileage and the expenses and all that stuff, when you put them in the little categories, it automatically adds them and puts them in the right spot, okay? But for now, we're kind of working with that, okay? And then we have another W-2, all right? Typically what I do is go to the first W-2. I'll go up to the top of my little white tabs, right across the top. And even though, since I'm on a W-2 and I'm getting ready to add one in for Sandra, I'm just going to hit copy the W-2. Creates a new one for me, and then I can put in that she's the spouse. We have the address. Okay. All right. And boy, that one went crazy on the tips, didn't it? Okay. So, shouldn't be anything in Social Security chips and shouldn't be a 414H. So we'll ignore those two, okay? All right, so we have the employee ID number. All right, she worked for First Starlight Bank. Sounds like a pleasant bank. Okay, must be only open at night, right? Madison Street. Okay. She had wages of $35,543.21. She had some withholding of, all right. She had, let's see, some dependent care benefits. All right. Like I said, we're not going to worry about the 414H for her. And they lived in New York. And she had her $1,800, okay? All right, so I got those in. It shouldn't have been in there. Typo in the problem. Looks like it when it copied the W-2. So yeah, don't worry about that on the 414H on her. Okay. Now, I am going to show you this on this one though. I didn't check the box on 3, 4, 5, and 6. Okay. If I were to put in here in my box 12, I were to put in a D code, okay, and I were to put in $2,000. All right. What did it do to the numbers up here? Okay. All right. So what I want you to do, if you have the problem open, instead of putting her in a 414H, take that out, go over to box 12, put in a D code, and put in her $4,666. Okay? All right. So under box 12 on her W-2, put the code D, put in 4,666. And then I want you to look at box 3 and 5 up above and tell me what happened to it. Yeah. See, it rolled her income back up higher for Social Security, but left her low for taxable because we got to subtract out her contributions to a 401k. Okay, everybody see how that worked? But like I said, that's what you have to understand, that a 414H is exactly the same. I think that was the intent of the problem, is that it's exactly the same. But on a 414H, we have to manually do it up above because it's handled different on the state. Okay? All right, does that make sense to everybody? I'm seeing some confused faces. Whether it's a D for a 401k or a 414H, they're both contributions out of your income to your retirement, which means that the taxable wages in box 1 will be reduced by your contributions. Okay? So box 3, what you get credit for with Social Security is going to be a higher number because that's what you actually earned, but the government says you don't have to pay tax on the money that you contributed to your retirement, so it lowers box 1 for your taxable income. Okay? Those contributions, when are we going to be paying tax on them?
When they come out.
When they come out. Right? When they come out.
We're allowed to change W-2?
What do you mean?
We just changed this W-2.
Yeah, that just for an example.
Oh.
Yeah, we're not, so, okay? No, you're not allowed to change the W-2, so that's why I say, I think the intent of the problem was to kind of show you how the two things are handled so that you understood how to manipulate these numbers and why these numbers change, okay? All right? So we have that, okay? That being said, I have her owing 933, so let's go through everybody's 1040 and see if we got everything in here. Okay. If we go to page 1, 1040, I have income of $86,864. Is everybody there? Or did I have fat fingers somewhere along the line? Okay. Nothing till we get down to line 12. We have $47.99 on 12. Okay. All right.
Back to my comment on the taxable refund. They did get a refund, but the Empire Credit wiped it out.
Yes.
Is there a work, should we be doing a worksheet for that, or do we just know this and we can take that right off?
For what we're doing here to learn to understand what that number comes from, I want you just to know what you put in there. You have to do the math. Okay. Like we did in the problem 17-1, we knew that they had 1,066, and then they had 660. We have to subtract that. In this case, our refund was less than the credit, so it wipes it out. When you're doing it in real life and you have their 2014 tax return they brought in, and or you have the history that carries forward, our program, once you put in the Social Security number, it carries forward everything from the previous year that needs to be. Then you can do the worksheet. Right now, if you go into that worksheet on line 10, it throws everything off for you trying to get it in here.
Because we don't have the 2014.
Exactly. We don't have any history for it. But yes, you would do a worksheet because, you know, if you're unsure, you'd want to do that worksheet and have it calculate for you. Even if they don't have the child tax credit, Empire Child Tax Credit. Because there are instances where even if they don't have children, that their refund will be reduced. Okay? But like I said, we don't know anything about the Culver's 2014 return for us to be able to put anything in there. Okay? All right. Okay. All right. Any questions so far? So we're at $91,663 of total income. Remember, we talked about on the self-employment tax calculation that we get credit for half of it. So on line 27, we have $340. Okay. All right. So we have that. So line 37, we should have $91,323. When we come back up to the top of page 2 of the 1040, that number carries forward for us. Line 40, they got a standard deduction. They do say they itemize. Again, when we cover that, we'll probably come back to some of these problems. We have the 4 exemptions, the 2 parents and the 2 kids. We have their tax. You can see their child tax credit, Pac-Man credit. Okay, so there's no additional child tax credit on this one because we were able to use it to eat up part of our tax bill. Okay, so line 56 says $6,486. Line 57, there's where we see for his self-employment, his little side job that Mr. Culver has. We see on line 57 that the self-employment tax is $679. We had federal tax withheld of $6,232. So they were short by $933. Okay? So what would be the first thing I'd probably talk to them about?
Increase withholding next year.
Exactly. Yeah, they need to take a look at their withholding. Good rule of thumb, when you see the wages in box 1, and if their withholding is less than 10% of it, there's going to be trouble. So a lot of times as I'm putting the W-2s in, if I see that, I've already got my wheels turning because I'm like, this isn't going to be pretty. So, all right. So, you know, maybe the case like we've talked about, they may have gone exempt for a bonus during the year and forgot to change it back. If you listen to Esther on the radio right now, one thing because of what's going to happen since we're kind of on the earned income credit, earned income credit tax returns are going to be delayed this year. So you will be able to file your return when you would normally, but you're not going to get it back right away. Okay, because they are really trying to figure out a way to curb fraud in earned income credit. That being said, then they're going to take and it may be, you know, February 1st of March before they'll release those funds. Okay, so what we're telling people on the radio is change your withholding. Because if they're going to hold your refund and you need some of that money to tide you over, especially if you're a low to middle income, change that withholding for a couple months. You have bigger paychecks so you have money coming in. And then the other thing that we're doing, and we finally got somebody in New York to allow us to do it, we're doing what's called a pre-fund. It's not a refund anticipation loan, it's just called a pre-fund. And you can get up to $1,000 of your anticipated refund ahead. Okay, so we'll release it before the return is released. So again, it's not a refund anticipation loan. Those were loan sharking. All right, because some of them had interest rates of 160%. You know, people took refund anticipation loans. They are basically losing money, but they wanted it right away, walking out the door. Okay. All right, but yeah, that's where, you know, it's going to be interesting with the earned income credit. So, okay. All right. A couple more things on this. We're just going to kind of add in. All right. No, we're not. Never mind. Okay. We'll leave them alone. Okay. Because we'll probably get the chance to talk to them about here. All right. So on the state side, the Culvers live in Erie County. We have their school district is what, West Seneca? What's the West Seneca number? Anybody know?
689.
Oh, I thought you were going to make me look it up. All right, 689. Okay. All right. The Culvers informed us that they are not hiding money in the Swiss bank account. Okay, so everything's pretty much done there. We go to page 2. We can see everything coming over. Again, the first 19 lines on that IT 201 is everything from our federal, right down to self-employment tax. So we have the self-employment tax on there and all the adjustments. So our income's the same, but what changes? Remember our 414H? Because of the way we put it in there, and again, even though it says SUB for subtraction, it is under the addition. So what do we see here? 4,666 on line 21. All right. So we have to add that because it's added as income going in on the state side.
Did we just add that in, or was that already there?
It should already be there from Mr. Culver's W-2 when you put the 4666. Remember, we were kind of manipulating the W-2s. One, I had you put it as a D for her. Him, I had you put it as a 414H SUB. Okay. So did everybody carry over here? Yes, no? Okay. All right. So taxable income, again, they're just for right now, they're on the standard. They got the 2 dependents. We got their taxable income on page 3 of the 201, $78,139. Right now, New York says they should have paid taxes of $4,368. All right. On page 4 of the IT 201, we can see their 2 kids. And again, just means their kids are over 4 and under 17. All right. Is everybody going home looking back on their tax returns going, I can't believe I didn't get credit for those kids? Family relief, we talked about, that's the Cuomo clause. He sent you a check in his year of election. So let's see, when's he up again? 2 more years? Every 4 years for the governor again? Yeah. So that'll probably come as a check in another 2 years, okay? They're withholding. Okay. All right. So how'd everybody do on those? I got 1242 on the state. Did I remember to put the? Yep. Okay. All right. Okay. Any questions? Anybody have trouble getting any of that stuff in there? Yes? No? No? Yes?
I don't know what I told my income was.
Which one?
My income was like, oh.
Okay, so let's go back to. Seven. That's fine, that's good. Okay, now go to your schedule CEC. Okay, so you got it in there twice. Okay, so what happened is you put it on line 21, which is where we've talked about miscellaneous income. Okay, so if you look here, you got the $6,000 showing up on 2 lines. Okay, so we're going to take this miscellaneous one, and I'm just going to get rid of that.
Okay.
All right. Okay. So yeah, she was over efficient. Okay, we'll say overly efficient. Okay, make sure that 1099 miscellaneous. I know we learned that it shows that we talked about it going on to line 21. Okay, with other income, because that's where that miscellaneous shows up, and it even says what in boxes 3, 7, or 8 that we put it in. But if we're going to do a Schedule C or Schedule CEZ, do not put it on 21. Okay, because then they're paying tax on that money twice. Okay, all right. Okay. So apparently you work for the IRS.
I know.
So, okay. All right. Okay, so again, I know we learned 1099 miscellaneous, line 21, but remember our rules there, because if this is non-employee compensation, and as soon as they say they have expenses, we don't have any way to adjust on the line 21. We need to go to the CEZ because their income was over $400. Okay. All right. Any other questions? Yes, no, maybe? Okay. All right. Okay. What about 17.3? Anybody want to volunteer their answer there? Okay. Nobody's volunteering their answer there? Nobody's brave?
I got a balance due of $6,141.
Balance due? Why would that be?
I think it was winning the car.
Yeah. Okay. All right. I'm glad my daughter just won $5,500 in braces and didn't win a new car. Okay. Everybody kind of see, and that's one where sometimes you're kind of unsure, you're kind of scared going, they really owe that much. Well, what was the value of the car? I can't remember.
3.5.
23,500? Yeah. So what do you think would happen to you if you got a $23,500 paycheck and had no withholding on it? Okay? All right. All right, Fred, you're going to be the teacher on this one. Go to 1040, page 1. Has everybody got their, who's this one? The spinners. Okay. All right. So go 1040, page 1. What do you have for wages for line 7?
94,562.
Okay. Everybody in agreement so far? Okay. All right. Okay. What else do they have?
Taxable interest, $56.
Okay, so we have a 1099 INT in there for $56. What type of interest income was it? Just regular, wasn't bond interest?
Regular thing.
Yep, okay, all right. Okay, keep going.
Taxable refund of state taxes from last year, $348.
Okay, and how did you come up with that number?
Biggest total.
Okay. They told me it was. Okay, all right. The spinners seem like very honest people. They just told me that's what it was, okay? Because what's the little disclaimer that says there? They did not receive any credits from New York State last year. So, you know, again, without having their history or their tax return, we can't do the worksheet to validate that. So we're just going to say that they owe $348. They have to pay tax on it, okay?
Did you say that the state does not send you a 1099?
1099-G, yeah, I remember you used to get the little postcard in the mail, and even the postcard, they would have adjusted it for you, but you're on your own now, so. And they stopped that 2 years ago, so which means for your 2016 return, probably everybody's gonna be getting a lot of little love letters from the state of New York. Okay?
The only way to tell is to really know is to get last year's.
Yes. Yeah. Anytime somebody comes in as a new client, I definitely, because, you know, as we talk more about things for maybe carryover losses from the sale of stock, things like that, you have to have that stuff because otherwise, you know, we don't know and the client may not know. Okay? All right, what do we got next?
Other income in line 21, 23,500.
Okay.
For moving the car.
Yep, so this is one that our 1099 miscellaneous would be on 21, okay? Because what box was that income in on that 1099 miscellaneous? 1099 miscellaneous was in box 3, other income. So since we had 3, we know we can put it there. All right? If that was in box 7 for winning a car, that would have been an incorrectly made 1099. I would ask for them to get another one. Because I'm trying to save them a little bit, because if it's in lines in box 7, then that 23,000 is also going to have, besides tax on the winnings, so self-employment tax. So that's another 15% they would have paid on. Okay? All right.
Tim, where was the price of the car?
What?
What the miscellaneous.
1099 miscellaneous on page, what page?
Oh.
Yeah, 1099 miscellaneous on 227.
Oh.
Okay?
That's
All right. Okay? All right, keep on. So we're down there. So what's that create their income to be?
118,466.
Yeah. Yeah. So, okay. No adjustments right now. So that's their total adjusted gross income.
How we doing now? I'm doing terrible.
What happened?
I lost that printer here when we.
Yeah, but
I'll spell it twice. I'm trying to restore it.
Oh, no, I did do that.
see, that's why I thought that it was income sheet. It was only the income sheet. So I was like, what are you? I don't know where that.
So on there, you don't have it on.
No, but I had it on the first one, but I had 9 of them on there. I took this column.
I couldn't find it on the tree. And I went up to
So it should be saved.
I think you backed up and overrode it. Sure. Well, here, yeah, so it's on your computer at home. You didn't lose it.
No, it's at home.
Yeah.
So it's not on here, so
All right. Okay.
I'll watch the film.
Check. All right. Okay. And then we have their standard deduction and the exemptions for the three of them, the children. So looks like we have taxable income of $93,868 on 43. They got a nice tax bill of $15,056. Okay. All right. Reason being is because that 93,000.
Yeah, I don't have it. Was it 118, 468? Okay, 118, 467.
Mhm.
I have 16,000. You do too?
Do they have two dependents or one dependent? The spinners have two. Uh-oh, Fred, you missed one. David's hiding down there under the over 19.
And, you know, I excluded one of the kids because it says the child was 21 years old and not 21. So I didn't put the other one on.
Well, David.
He was the college kid.
So the second bullet point says David started his second year at a local college this past fall and is classified as a full-time student. Yes, Daniel is not. David is.
Oh, Laura. Laura's the other child.
Laura's the other
David and Laura are the kids.
Yeah, that's the cat.
And then you say David. David's in college. Nothing about Laura, so I thought he was a trick.
Nope. Nope. And Laura is a daughter.
No, I understand.
The same birthday.
Yeah, I know. I know. So why is one under?
Yeah. All right. Yeah, so you have to have a second child out there. Yep. Okay.
It changed her birthday because it said under 19.
Yeah. Yep.
The birthday is, I put 1997. Yeah.
Oh, I had 94.
Okay. So there's a fourth child on there, so.
We changed the birthday? I did.
Yeah.
If you're younger.
Because it said
Yep,
she was
make her
over
1997.
It worked for me, I think. 90. Oh, okay. So just like that.
This is home child tax credit. Okay, so go back to page 2 in your 1040. All right. So it looks like, yep. So it looks like the taxable income is $89,864. Or excuse me, 66. I don't have my glasses on. Okay. So they got 14,000. Now, what happened with that is the threshold for married filing joint. And this is where they got zinged. The threshold for married filing joints, 15% tax bracket stops at $74,900. So what did that car do to part of the proceeds from the car? Yeah, so $15,000 of that car is in the 25% tax bracket. Okay, so even though they've traditionally been in the 15%, that pushed their taxable income high enough that some of it's 25% bracket. Not all of it, just because you're in the 25% bracket. But everything over $74,900, they're now paying 25%. So that means $15,000 of that car that they won, they paid 25% on. Gonna make you think twice?
I don't want to.
So, all right. Speaking of gambling winning, did you guys hear the story about the wife that was trying to teach her husband how silly scratch-off tickets are? Has anybody heard this story? And she took him in and they were going to buy his last scratch-off ticket and see, because she wanted to show him that they never win. These things are never winners. And Gene, what happened? They scratched off and what happened? How much? It was like $1 million. So, yeah. Yeah. So 2 things happened there. I'm sure the husband's going, So, great. Now you just got us, $500,000 in taxes. So, all right.
Probably think it's my money.
Yeah, well, yeah. So, yeah. So she's probably thinking, let's see, if I get half of it as alimony prior to, he does, well, no, I'll have to do it as maintenance, so I don't have to pay tax on it. So,
What did they say? It was something like 300,000 after tax?
yeah, when you pay the tax up front. So, like I said, all I think that the lottery, all it is the tax on the lower class. Really is, because if you have somebody that thinks that they have that get rich quick and they can do that, both what they're paying in and what the tax is on when they win, it just, to me, it seems like another tax.
So it's better to take it as a lump sum or spreading it out? Because you have to pay tax on either way, right?
Yeah. Yep. So, and as I told you the story about my client that his wife with the alimony, she gets half of his lottery winnings every year for 10 years. Okay, and it's not alimony.
Yes, it's
So he pays the tax on it because it's all in his name, but she gets half of the gross. So be
Can
careful.
you go back and get another lawyer and change that?
I kind of informed him. I said, you didn't have a very good lawyer. So he goes, I know. So, but, so yes, I guess to your question, which is better, the lump sum, it depends on how solid you think your marriage is as to which one's the better. Do you get it out of the way up front, or do you run the risk that down the road somebody's going to get half of it? It just depends. So,
But is the tax rate the same?
pretty much. So, but you have to look at that because, once that money, basically once that money goes over, married filing joint taxable income goes over 464,000, it's taxed at 39.5%. So yeah, you'd have to have somebody really planning well to make
If
sure.
you got a lump sum, you could like put in the bank and you get it every year.
And that's where a lot of people that win the lottery go broke, because they buy these things and get themselves, and yes, they can afford them and pay cash for them, but they don't look at, A, the tax implications, and B, yeah, I bought a brand new home, but do I have the income to pay the property taxes on it while I live there? All of a sudden they can't pay the bills for what they paid cash for. And that's a shame, because, then somebody didn't manage their money very well. So, okay. Yes.
For the spinners,
Yes.
did you use the part that says they paid 200 quarterly or federal?
No. That was where I had you just underline the part, because we haven't done estimated, so we weren't worried about that part. Okay. All right. So I think we got everything in on that one. So what numbers did everybody come up with? Did we get everything in there? What was the federal refund? That's what I have here. Yeah. They owe what?
I had 5,050.
Yep. And they owe on the state too, okay? So basically, where's all their tax bill coming from? Is that car, isn't it? Okay? All right. All right. Any other questions on that? All right, let's take about 5 minutes and then we'll get into chapter 13, okay? All right. All right, so let's do chapter 13. Oh, that's much better. Now I can see all the faces. I don't have to peek around the monitors much. Okay. Chapter 13. All right. And as you can see on this one, it's breaking into two parts. All right. First part we're going to cover is for the non-refundable credits, and then we'll have another one in chapter 14. Okay. All right. As I said last time, I didn't give Tiffany credit for her analogies. We got some of those refundable credits we talked about. Those are our Energizer bunnies. Even after we've eliminated our tax bill, they keep going on and on and on to the beat of the little drum, okay? We're now into the Pac-Man credits, all right? And if you know what Pac-Man is, Tim, you might be too young. All right, okay. Looking around the room, there's several of us. This is when we used to have to go to an arcade and put a quarter in a machine. We didn't have little things on our TV at home. If we did, it was Pong, where you had the little thing that burnt in the little thing on your screen, ruined your TV. Yeah, so everybody's nodding. Yeah, so you're showing your age. Exactly, okay? And Tim, too, that's when our phones used to be wired to the wall. We couldn't go any farther than the cord. Of course, your generation's the same thing because my kids are always plugged into the wall because their battery's always dead. So, all right, so non-refundable credits, okay? Again, these are the ones that are Pac-Man. They're going to eat and eat and eat and eat till they eat up our tax bill, okay, or that they're gone. There are portions of them that are refundable. So if we've eaten up our tax bill and we have remainders, like we talked about with the additional child tax credit, we're going to keep getting them, okay? So that's what we're going to do. If I take a look at my return, really the section that we're looking at, and that's why we broke it into two sections, is its own section on the tax return called non-refundable credits, 48 through 56, okay? Because they are there after our tax bill has been calculated, all right? But before some other taxes. So that's what we're going to do, okay? This part of the non-refundable, our objectives are to understand the difference between a tax deduction and a tax credit, okay? Deductions lower taxable income. Credits eat the taxes, okay? So if that's the difference between the two, all right? Understand the difference between non-refundable and refundable. As I said, Pac-Man versus the Energizer Bunny, okay? Foreign tax credit, there's a lot of stuff in here on it. It kind of falls in the same category as that one when I talked about the credit for capital gains unrealized. I'm going to show you how to do the foreign tax credit in about 2 seconds, okay? All right. The test for child and dependent care, the American Opportunity, and the Lifetime Learning Credit, okay? So those are the ones that we're going to talk about. As I said on there, tax deduction versus a tax credit. It says that each payer pays taxes based on their taxable income. The tax due is paid is a percentage of that taxable income. So when we look at our taxable income, all right, we're looking at something that we're going to reduce. Okay, that's a result after we take our deductions. So we hear the term standard deduction or itemized deductions. All right, so they got a few examples there where it kind of shows where the credit versus the deduction. Now, the other thing too is that they talk about there, and a lot of times you'll hear this, especially in presidential elections, you'll hear about the thing called the effective tax rate, okay? So their tax bracket is based on their taxable income. But because of credits they may take, it may make their effective tax rate different. What I'm saying is that a lot of times our credits will lower what truly is our tax bill, okay? That's where it's the effective, okay? All right. All right, so those are kind of some reading. We have non-refundable tax credit. We're on page 13.6. We got non-refundable tax credit versus the refundable tax credit. Again, Non-refundable credit says if the tax credit is more than the tax total due, the tax due is reduced to zero, but any excess from the credit is lost, okay? That's true and that's false, again, depending on which credit it is. The refundable credit, all right, if the tax credit is more than the total tax due, the tax due is again reduced to zero, and any excess from the credit is refunded to the taxpayer. Energizer Bunny goes on and on and on, okay? All right. Okay. All right, and it's got some different boxes, shows some examples on some different calculations where, you know, how the, you know, taxable income, the tax due, and how the credit affects different things, whether it's refundable or non-refundable. Again, it's just kind of to show you all the different calculations and how those numbers are manipulated. And again, talks about that effective tax rate. Obviously, you know, if it were the case that we learned that we're in the 15% tax bracket after we get our taxable income, that'd be it. We'd pay 15% on it and we'd be done. Okay? So if you look at the, like in the tax-wise problem, all right, we got our standard deduction. We got our exemptions for our household. There's our tax. We'd be all said and done. Then our effective rate would be the same as whatever the tax table tells us that we fall in. But we can make our tax rate lower by using credits, non-refundable and refundable. Okay, so even though you think you're paying 15%, you can reduce that if you have access to credits. Okay, does that make sense to everybody? All right. I can remember that was a big thing, was, they didn't talk about as much in this election, but I can remember last time with Mitt Romney because of his contributions. He didn't have any of these foundations like the candidates have this time, but they kept talking about the fact that he was only paying 10%. Well, what they were doing is twisting the words. That was his effective because of some of the credits and things that he had and the deductions. All right. You know, they knew his income was well above and he should have been paying 35, 40%, but they kept saying, well, he's only paying 10%. Okay. You can't this time say that they're not paying taxes. So I guess that probably, so yes.
Is he talking about having a flat tax rate? You think that will-
Flat tax rate, in theory, it's great. Makes sense. I mean, it wasn't that long ago that you got a postcard and you sent your tax return in on. You know, what money did you make? Here's your taxes. You know, but my feeling with the flat tax rate, it is so hard to figure out what is fair and equitable all across the country.
Yeah,
Okay.
because they always want to, they say they're gonna tax the rich more, and but if they do this, it's just the same as like the poor people pay.
Well, like I said, being somebody that grew up in farm country in the Midwest, what's rich out there is not what's rich in New York City.
Yeah.
Okay? Cost of living is totally different. You know, when I go back to, you know, visit my in-laws right now in Missouri, gas is about $1.75. Okay? So cost of livings are all different. Housing, another prime example.
Yeah, I don't know if they ever do that.
Yeah. You know, when you're trying to compare somebody that makes $100,000 in New York City and somebody that makes $100,000 in Lincoln, Nebraska, is that necessarily the same $100,000 to be taxed at the same rate? Okay. And that senator in Nebraska and that senator in New York, do you think their constituents have the same interest? Because if the New York guy says, well, yeah, flat tax, but, you know, I got a bunch of people in mind that just need this little because they don't have cars. And Nebraska's saying, well, that's not fair. They get it on their cars. We don't have as many cars. But we should get it for our tractors. You know what I mean?
Yeah,
So
we
you
get rid of all credits and everything.
Exactly. Even think about New York. Think of a prime example. What were they going to do with license plates about 2 years ago? They were going to require everybody to buy new license plates because they wanted to redo it. Okay? Fine. But 70% of the population lives in New York City. How many of them do you think has cars and would care? So you were basically made a tax for a state, a flat tax that most of the population in the state of New York wasn't going to have to pay. It was just a tax on upstate. So you know what I mean by the flat tax? Because everybody that they're saying, everybody's the same. Everybody's going to have to buy a new license plate. Well, if I don't own a car and I live in New York City, you know what I mean? So
Well, that's like the real estate tax.
Mhm.
At the school, you pay for, if you own land, you have to pay the tax to the school, but people live in apartments, they don't have to pay that.
and that's where you see some states have local taxes because they want to get school tax. Yeah, you know, and you know, like I said, my son lives in Ohio and not a resident, but he still pays. We have to do an Ohio State local return for the city of University Heights. So, and the other thing too, you're talking property tax. I guarantee the property tax rate for a, okay, $200,000 house here in Niagara Falls. Do you think that $200,000 house is going to be the same what you can get on Long Island? No. No. Okay? Because again, you're talking about real estate differences. So I guarantee what you can buy for $200,000 on Long Island probably is something that is, you know, 500 square feet and maybe is above the garage on a house out there. But $200,000 in Niagara Falls is probably going to buy you a 4-bedroom, 2-bath. You know, so property, again, you know, when you have different costs of living and things like that, it's so hard to figure out where the equitable rate would fall. You know, it's just hard. Concept-wise, yeah, everybody pay their share. But again, like I said, you know, when you get politics involved and says, well, that's not fair to my constituents. We need this little adjustment for them. Well, as soon as that happens, then somebody in Montana is going to say, hey, you know, we live out here, you know, this does not apply to us. We need this so that you can get that. Well, that's where a lot of the tax code 74,000 pages come from. Because somebody, you know, that's where when you get some of these and you're going through like the one about the fish, obviously somewhere along the line, there was somebody that felt like it was very important that the fishing industry got a tax break. So, you know, we're looking at going, you know, so, all right. But good question, okay? So we have on those. Foreign tax credit. So we're going to kind of start and go right down our foreign tax credit. So if we're on line 48, and I go into my little form tree here, I got this wonderful little 1116 foreign tax credit, okay? And it is 4 pages. Sometimes it's the alternative minimum tax, okay? So part 1. All right, you can see here, I have my country possession and country code. I have to look that up. My gross income from that country, I have to file a 2555. Then I have to carry it to the Schedule D for foreign income, okay? I can see on your faces you're all going, whoa, wait a second, okay? Foreign tax credit, all I want you to worry about when you get them is the little paragraph at the top. And what is it called? Simplified limitation election. Okay? How many are in favor of something called simplified? We'll do an election. Everybody raise their hands. All right? So majority has it. We'll stick with simplified. Basically, it says if all the foreign income sources from dividends and interest from income is reported on forms 1099 DIV, remember that little foreign income tax? We went through those boxes, okay? And is not more than 300 or 600 filing joint, you don't need to do this form, you just put it there. Trust me, unless somebody lives in a foreign country and has investment income in that foreign country, on people's stock portfolios, you're not going to see more than $600, all right? Usually I see ranges from about $25 to about $75. And like I said, Lord Abbott, whoever Lord Abbott is in his mutual fund, they always have foreign tax in it, okay? So basically what I'm saying is, it is a credit that helps us eat up our tax bill. It will show up on that 1099 DIV. We put it in that box, and we've just done form 1116, Simplified method. That's all you need to know, okay? But basically, you're getting a tax for any tax that you paid in a foreign country, all right? Especially if you own stock and you're helping the company or whatever it may be, all right? Okay,
Tim,
yes,
by putting it in there, it'll automatically carry to page 2 of the 1040,
yes.
but we have to put it in there. We can't-
You have to put it in there. Yes, that's correct.
You have a text message.
Okay, all right. So that is your education on the foreign tax credit. Like I said, it ranks right up there with the credit for the unrealized gain on capital gains, or unrealized tax credit for capital gains, okay? All right. So there's a bunch of information on there, but as we did our election, and we have decided to do the simplified method and majority rules, okay? All right. In fact, we're going to do it as an electoral. You guys have 10 electoral votes. I have 200. So I'm the one vote. My electoral of 200 outrules your 10. So we're doing the simplified method, okay? Isn't that the way elections work anymore? Doesn't matter on the popular, just got to get the electoral? Okay, all right.
Because even if they have more than one 1099, we just add them all up with foreign tax.
F5, add them all up and stick them in there. And like I said, you're not going to see over 600. If you see more than 600, it's because you have some. The only time I see it is if I have, again, I've kind of talked about that 25-55. If I have somebody that's a U.S. citizen that is married to a Canadian living in Canada, they have to file the return, I'll see it. Because then I have to pull things out of their Canadian return because they may have dividends on their investment accounts in Canada. But again, you're not going to see it. I see probably 10 of those myself a year where I have to do that and do all the form. But is anybody here not a U.S. citizen? Is anybody married to a Canadian living in Canada? Then you don't have to worry about it, okay? All right. Michelle, did you do any with foreign tax credit last year?
Not that I can remember.
You probably did the simplified method if you did, because if you
And if I
would,
did, I put it right on that one line.
yeah, exactly.
There's someone that moved here but still owned property in your own country. And I guess they still owned land or
At a residence.
residence there.
Again, remember I kind of told you about my little group of professors from UB, the one guy that's from Austria. Rest of this form, the 1116, yes, I have to do stuff because he gets credit. Because tell you what, they pay a lot of taxes in Austria, but boy, is their Social Security good. Okay, so he would get credit for that, and even though he has income from working at UB when he's here part of the year, but he's not going to pay tax. He gets credit on that income from the foreign country and the property taxes and taxes he paid there to go against what he might owe here. So basically it's saying that the federal government's not going to double dip on it and taxes foreign income. So that's where the credit comes into play.
So here he'd be a citizen of Austria, but what would he be considered here?
He's a citizen here too.
Oh,
Dual citizenship.
oh,
Yeah, so, yeah, because they have a residence here too.
oh.
And they're both U.S. citizens, so, yeah. But like I said, I always have to have them translate because he has to return in Austrian and euros. So I have to go look up the exchange rate for euros every year. I got smart this time. I have it as a shortcut on my desktop.
So do you have to do an Austrian return?
No, I don't do Austrian returns. He brings that to me.
Oh, I was
No,
gonna say,
no.
state.
No, I don't even do Canadian returns, so in fact, Gordon, who was in our office,
Yeah.
he's actually moving up here because they bought a house up in Lewiston, and we're sending him over to Canada for 2 days to learn to do Canadian returns because of this location, because we do a lot of Canadian returns. So we'll have two people, Marcus that works at the corporate office and Gordon, but we do Canadian returns.
Oh, how many of us are good at it?
Gordon's not going to be there.
You know, but if you take him.
I'm gone. You're there by yourself, Michelle. That's why you're in this class. You got it all by yourself. 2,000 returns we did there last year. You all set?
Yeah, I'll live.
Loosen up the fingers. All right, so that's foreign tax credit, okay? All right, 1310, we got dependents. All right? Okay? Child and dependent care. And again, it's child and dependent. Just because we think of daycare, paying for Little Lamb or ABC daycare or whatever it is, or Doodle Bugs, okay? Sometimes we have somebody living with us. It could be a mother or father that has, Alzheimer's, that in order for us to work, we put her in an adult care, so it's dependent care, okay? So these are a non-refundable credit that are available to taxpayers who pay for the care for credit who is under age 13, or for a spouse or dependent who is not able to care for him or herself, okay? So again, we have all those dependent cares on there. We saw on the W-2 that there are times our employer may give us, it falls under that cafeteria 125 plan. They give us some money towards that so that we can work for them, okay? At the bottom of 1310, test to claim the credit. To claim the credit for child and dependent care expenses, the following tests must be met. The care must be for one or more qualifying persons. So it just says qualifying, okay? Remember, for our study of dependents, qualifying child or qualifying relative. The taxpayer or spouse of filing jointly must have earned income for the year, okay? So, if somebody comes in, they have unemployment, and for some reason, the state is giving them money for their child to be in daycare, okay? Is that earned income? Could they, okay? And even though they might be paying for the child care out of their unemployment, they do not have the credit because they have no earned income. The expenses covered must be paid so that the taxpayer or spouse of filing jointly can work or look for work. So I guess you could say that, all right, okay? So if they're looking for employment, if they're on unemployment, all right? The payments must be made to someone the taxpayer or spouse cannot claim as a dependent. So we can't get in the vicious circle, okay? Mom lives with me, I claim her as a dependent, and then I pay her, and I take the child credit. Does that sound fair? No, okay, all right. If the payment were to a taxpayer, spouse, or child, they must also be 19 older at the end of the year, okay? Taxpayer's filing status must be single, head of household, or qualifying widower with dependent child. If married, the filing status must be joint unless an exemption applies. You're not really going to see that exemption, okay, because it just doesn't come up, okay? The care provider must be identified on the return, all right? Okay? Tim's my neighbor. I say, Tim, would you mind watching my kids while I work during the week? I'll pay you $500 a week. Okay? Tim says, sure. Then his next question to me is, are you going to deduct this on your taxes? Okay, and I say, why, of course. I need your Social Security number. Tim goes, I don't think I want to do it. Because when I babysit for the people on the other side of me, they didn't report it, so I didn't report it as income. See where I'm going? So when you pay somebody and you're going to claim it as a deduction, that person better be prepared to pay for taxes as income. Self-employment tax. Okay? See where I'm going with it? So that's why either the Social Security number or an EIN number for the daycare is necessary for you to take the deduction. Because you have to identify that somebody's receiving income. Because what's the IRS going to do? They're going to go after them. Exactly. Okay? All right. And then it talks about some limitations on the dependent care. All right. And then it has some more highlights about each of the tests that you can kind of go through there at the bottom of 1311. Then the infamous flow chart. Start here and go through several boxes and several routes. I always thought these looked like the wiring on a house. Okay, so if you turn this switch on, does the light come on? If not, you're done. So, Oh, excuse me. Hello. Oh, okay, so we didn't have it right.
I never. She was nice enough to let me. She was. Just as smart as going
Yeah, just put it all on my desk. All right. Okay, so we got our flow chart. All right. Okay. So you have to go through there and meet all the tests to see, you know, where it starts out. Was the care for one or more qualifying persons? If no, hey, then it's easy. I go right to the bottom. But you can see each one of those questions so you can see the disclaimer on it. Okay. Down at the bottom of 1313, the dollar limit. There is a dollar limit on the amount of work-related expenses used to figure the credit. This limit is $3,000 for one qualifying person or $6,000 for two or more qualifying persons. Okay, so basically, what you can claim to calculate the credit is limited. All right, and trust me, when you see daycare bills for people right now for two or more kids, no wonder they're working a second job. Okay, I feel bad for some households because some of them, their second job, that's all it's there for. There's no income coming into the house. It's going for childcare. Okay, all right. My son is in the same boat. Okay, all right. Now, on, let's see here. Let me bring that last return that we did up here for, let's see here. Was that the Harmons? Which was the first one from 17?
The Culvers?
Oh, there they are, hiding up at the top. Okay, the Culvers. Because we know that they had $1,000 that was taken out of her W-2 for dependent care benefits. Okay, so her employer was giving her $1,000. So if you remember on W-2 in box 10, she had $1,000 in there. Okay, and we checked that the little guys were in dependent care. So once we checked that on the main information sheet, we get a 2441. This is the form to claim the credit for the child dependent care expenses. Okay, you can see up top we have the person or organizations who provided care. All right. You want a printed out statement. Kids are in the after school program for the Y. They're great. They print it out. Shows what may have been paid by somebody or if they got a break and what they paid. And that's what you want because, again, it's one of those credits. It's only what comes out of your pocket. All right? So, on this one, if I go back to Culver's there, Culver's here. In your workbook at the bottom of 220, we have Peter Pan Nursery. Okay. All right, and Peter Pan Nursery is on 55 Peter Pan Lane. Okay. All right, and if you notice on there, there was an ID number, so they have an employee identification number. We checked the box for the EIN number. All right, we have that they paid $3,082. Okay? All right, so that's what we paid to Peter Pan Nursery. As I go down a little farther, we see that we talk about the credit for child and dependent care expenses. All right. Now, what happened to my number here? It went from 3,082 down to 2,082. Why?
Oh, because
Go ahead.
because you got dependent care benefits.
Exactly. Okay. All right. Because we can see on that, it says only list below those expenses not excluded on page 2. Total not excluded on page 2 is this. Okay. That exclusion, if you go to page 2 of the 2141, you can see part 3 there. What's right here? It says box 10 of your W-2 forms. So it's excluding a little bit of that income. All right. Everybody see that? Okay. So we exclude that that's on there. All right. So back to 2441, the first page. We have Anna. It says on our little statement at the bottom of 220, we paid $1,000 for Anna. And we paid $2,082 for Caleb. Must be the problem child, huh? They're charging more to have him there. All right. Okay. Then you can see our calculation. It says the smaller of line 2, $3,000 or $6,000, whatever it may be. Okay. All right. So what's it show up as? Remember what line 2 was? I got it off the screen here, don't I? Okay. So we got the smaller. Line 2 is the smallest of the 3. We got 3,082. We have 6,000. And we have 2,082. So we're going to take the smallest. Because what is that actually? It's what we paid out of pocket. All right? So it's only that out-of-pocket dollars. Then you can see in the calculation there that it takes into account their earned income, does some calculations for us. 20%. So when it's all said and done, $416 credit they get. Okay? Now, the unique thing about the child credit is that it is a non-refundable credit on the federal, but on the state, it is an Energizer Bunny. So sometimes people may not get the child care because of their income and their deductions and things like that. You might not see a credit for them on the federal, but you may see it on the state, okay, as part of their refund. All right. So that's a little New York State, okay? Everybody see how that worked? Okay. On 1316, you see the kind of the little, the taxpayer's credit is determined by multiplying the work-related expenses by a percentage from the table below. So the more income you have, the less percentage of your child or dependent care expenses you're going to get. All right. In this case, we're at 90,000. So what it mean? It went over the 43,000, so 20%. If they had their adjusted gross income of 23,000, you could see that number would be 30%. So it is a credit that kind of adjusts by income. Okay. Yes.
Question,
Mhm.
one of the stipulations is that they have to be working or looking for work. Then there's a problem in here, I was looking ahead about one of the people that is going to college.
Mhm.
So,
But do they have a job?
no, I mean, the spouse does.
Well, so the spouse, then they qualify for the credit because there's earned income on the return. All right? Do you know what I mean?
Right.
Okay. All right. 13, 17, and 18 have the forms that we were just talking about. Okay. All right. Okay. Yes.
It was so confusing that I thought on the top of page 1317. There was talk about this George Smith with 2,900 in expenses, and his employer paid 1,000.
Mm-hmm.
When they deduct that 1,000, it says he can figure his credit at only $2,000.
Yes.
Shouldn't it be less than that? Should it only be 1,900? Because you take the 2,900 expenses, deduct the 1,000 that the employer spent.
But he paid $3,900 to Little Red Riding Hood.
Now you pay 2,900. On 1316 in the, not in the book, but in the text, the reading material.
Yeah, so the problem should have had it up there is, yeah. Yeah, kind of unclear.
Because I thought his credit would have only been on 1,900.
But it says he pays expenses, so it came out of his pocket, 2,900. So I think they're looking there as your out of pocket. You know what I mean? His actual bill was 3,900, of which his employer paid 1,000.
Okay.
Yeah, I think that's the way it's reading. I'd have to look at it closer. So, okay. All right. Okay. So, child dependent care. All right. Everybody see how I got that in there as far as the credits? Then if we go to our 1040, page 2, on this return, we can see under our credit for dependent care, 416, carries right over there for us. Okay. Real quick, I'm just going to show you New York here. So if we go to the New York 201, page 4, all right, we can see we got a nice little credit here, okay? And again, what does it say it falls under? Payments and refundable credits. So even though you may know from looking at things on somebody's tax return that they're not going to get anything for a child care credit, if they have it, put it in. First thing they're going to say to you as you're going through the return, they're going to get to that and say, what do you mean I don't get any money for it? Well, your income's high enough, the government's determined that you can afford your kids. So basically, they started paying college tuition when they were 5 for some of these places, okay? So, you know, you have it there. But you want to go ahead and put it in because if they get a credit on the state, it's refundable. It's an Energizer Bunny credit for the state, okay? So you're going to get it no matter what. All right. All right. Moving down the road here. Whoops. We're going to go back to 1040, page 2. And as we're heading down the road, our next one is education credits. Okay. And I think I talked a little bit about education on the refundable side. And I told you about my little friend that came in with her friend on her taxes, right? So, okay. All right. So if your son or daughter is in college and they're studying chemistry, make sure they're not doing any extracurricular activities because it will eliminate their
Education.
exactly. Okay. All right. Okay. So our education credits kind of have a couple components here. So this one gets a little bit fuzzy. If you don't have college students right now, you might have remembered this credit as the HOPE credit, is what it used to be, and now it's called the American Opportunity Credit. It's amazing. It's one of those credits that they always talk about it expiring. The lifetime learning credit that we're going to talk about seems like it's going to be around forever. But this American Opportunity Credit, where it has a refundable portion, an Energizer Bunny portion, every year you hear that it's on the chopping block. And then for the 11th hour, it comes back. And then obviously, if you hear it in our political rhetoric right now, college tuition and student loans are a huge, huge thing. Okay? All right? So the credit's very important. And this is a credit. Like I said, make sure that your son or daughter, if they're dependent on your return, aren't, because it's going to be a test on there, okay? So this section is going to explain the tax benefits available to taxpayer is saving for or paying education costs for themselves, or in many cases, a student who is a member of their household. We have two. American Opportunity Credit may be partially refundable, otherwise non-refundable, and the Lifetime Learning Credit is non-refundable, okay? Has the two columns there that they talk about it. Okay, I want you to have that for reference, all right? On page 1325, it says claiming an education credit. Generally, the taxpayer can claim either the American Opportunity Credit or the Lifetime Learning Credit if all three of the following requirements are met. The taxpayer paid qualified education expenses of higher education. Again, paid, all right? The education expenses were paid for an eligible student, all right? Again, not convicted of any felonies that we know. The eligible student is the taxpayer, their spouse, or dependent for whom the taxpayer claims an exemption on their return. That's why we talked about when you have that child and they don't check that little box and you go to try to put them on their tax return, you not only lose their dependent exemption, but you lose their education credit. And that's where it can swing the bill $3,000 or $4,000. Mom and dad aren't happy. The child thinks they deserve that money. All right? And you just have to kind of sit there and go and smile. Okay? All right. Okay, so for the education credit, what I want you to do, if you have a return there, let's stay with the Culvers. Okay, because they had. Okay, so we have the Culvers here, all right? They're going to have an education credit, okay? So on line 50, the 8863, that's our form for education credits, okay? And again, this is one of those things that's much easier to see in the form, all right? Okay. So typically we'll get a form that's called a 1098T. It's a little tuition statement. These are just like 1099Gs. The schools hate sending them out, never get them out on time. And because they want their children or their students or their undergrads or whatever to be savvy technology people, 1098Ts very often are online. And they are buried in their financial aid section of their portal or whatever you want to call it, okay? You know, that's where when I ask the parents, well, do you have access? Well, yeah. And we get in there, you know, if they call up the students, they're on their phone going, here it is, you know, okay? I know there's going to be a day, and it's not too far off, where everybody will just come in and I'll ask for a form and they'll go like this. Then they'll go next and then they'll go like this, okay? Because nothing will be in paper. It'll all be on their little phone. You can see that the educational institution information, we have to see that they're a page 1 of the return, their social security number. We have to have an educational institution, a qualified education institution, all right? Pub 17 and the Quick Finder will talk a lot about that with the education credit. Even Can't remember the name of it. It's over on Sheridan. What's the beauty school that's over there? Marchand, is that what it is? Yeah, it used to be one that was over there. That even qualifies as an institution for higher education because they are teaching in there, they are teaching them business. Okay, so even for that, they may be eligible for the education credit. Okay, doesn't have to be what you traditionally think of an ECC or UB or anything like that, like a typical college, university, community college. So there are even schools like that. And obviously in this day and age, online. Okay, you're taking school, and if it's a certified school, it's qualified education. Okay, all right. So it has to be a qualified school. Okay. Like I said, the 1098T. The other thing is the 1098T will ask if it's for undergraduate or graduate. Okay. American Opportunity is for undergraduate. All right. The lifetime learning can be for undergraduate or graduate. Okay. Obviously, the American Opportunity is just for undergraduate because it has a refundable portion. So we would answer those questions on there. Okay. We get our information in there. This is our middle section where I have to go through with everybody. And this is where the diary you need to know. Because has the whatever been claimed for the student for any 4 years before 2015. American Opportunity, you get for 4 years. That's it. You're done. Okay? If they're like most college students, they're probably on a 5 or 6 year plan to get that 4-year degree. Okay? They can do lifetime learning after 4 years, but the first 4 years. Okay? So we'd answer that. Has to be at least enrolled half-time. All right? So the school will determine on the 1098T where they at least a half-time student. If I'm taking one class for 3 hours or whatever it may be at the community college, it's part of my first 4 years, nope. Chances no. Okay? Did the student complete the first 4 years of post-secondary education before 2015? Again, they're really hammering it on that first 4 years. And then here's the question. Was the student convicted before the end of 2015 of a felony for possession or distribution of a controlled substance? Okay? All right. If yes, go to line 31. You still get a credit. So at least if you're a felon, you can still get a credit on your tax return. Okay? Maybe one of the only chances. All right? But if it's no, we'll go down here. Okay? Now, this is where the credit and where the information for the credit, and let's see, where did they have? If you look at the bottom of 1324, the little table that has the comparison, if you look at it, there's a couple things too. There's a phase out on this, talks about the refundable portion. Again, we have the number of years, okay? Talks about the courses and things like that and qualified expenses. All right? Now, all those are our test. The other thing is we cannot put in any number greater than 4,000. If any of you have a son or daughter that is going to a college where the tuition is $4,000 or less, please let me know, okay? Because I need to have my son transfer and I will enroll my daughter immediately, okay? Obviously, higher education, $4,000, that's just the number they use for the credit because that maxes out to $2,500, okay? You're gonna see somebody going to Canisius, they're gonna hand you a 1098T where it says college expenses paid, 38,000 whatever. And that's not including room and board because those are not qualified education expenses, all right? So obviously, if I put in 38,000 in here, that's fine. It'll calculate my credit to $2,500 if my income allows, if I'm not in what's called a phase out. Does everybody know what I mean by a phase out? Okay. What a phase out is, it's one of the credits that if your income for the American Opportunity married filing joint, as soon as the household income gets to $160,000, the light that goes on for the American Opportunity Credit starts to get dimmer and dimmer and dimmer and dimmer until your household's at 180,000 and the light goes out. Okay, that's what a phase out is. So you get to a certain level, okay? All right, and then obviously here it talks about 4,000 and it does some calculations because the 2,500, all right, 1,500 of it is refundable. Excuse me, 1,500 is non-refundable, $1,000 is refundable. Okay. Qualified education expenses. Okay. Okay. All right. Qualified higher education expenses. They are tuition and fees required for the enrollment or attendance at an eligible education institution for the taxpayer, spouse, or dependent. Charges and fees associated with books, supplies, and equipment are qualified expenses if the amount must be paid to the eligible educational institution as a condition of the enrollment. Okay? All right? If I am a art major and I am required for my classes to have brushes and paint, would that be qualified education expenses? Okay. If I am a computer science major and as part of my education I have to have a computer to program, would my computer qualify? Okay. All right. If I am at ECC in the auto mechanic program, but I'm taking a home ec class, are my spatulas? Okay, kind of see where I'm going with it? All right, qualified, you have to really be careful on those, okay? All right. Expenses qualify in the tax year paid. Payments must be for education that begins either in the same year or in the first 3 months of the following year, okay? What that means is, if for any of you that ever had college students, when do they typically bill the tuition for the spring semester? In the fall. And your scholarship paid. That's why it's the first 4 years, because what happens in that last year when they graduate in May? You're not getting the credit for it. It was rolled into the previous year. Equally, they graduate from high school in June, they're going to college in the fall. That first year really has a whole year's tuition in it. So where I'm kind of going, things are kind of rolled a semester ahead. So that's why that first 4 years is so important. You got to find out when they started in the first 4 years. Because the year they graduate, they're probably not going to get the credit. Because their tuition was rolled into the previous. Okay? The other thing it talks about too here is out-of-pocket expenses. You do not get to include scholarships. Everybody read that? Okay? But what do you get to include? Anybody pick up on it in there? As out of pocket? What's the infamous thing that every student in college has right now? It's loans. You're shaking your head. You experienced in loans? Okay, all right. Student loans. So whose money is that student loan?
The students.
Mm-hmm. But do I really have it? No. But because really I am going to pay for it when? The rest of my life. Okay? Borrowed money does count as money paid in that year. Because basically you took a loan, got a check, and gave it to the institution. All right? Scholarships, no. Because you don't have to repay a scholarship. Correct? Okay? And the one thing about scholarships, you have to be very careful. Because if it's a scholarship that's paid directly to you, not through the institution, what happens to that scholarship? Could be income. Could show up as income on a W-7. Or line 7, I'm sorry. Okay? That's where you see on line 7 with 1040 that thing about scholarships. So My father is a member of the American Legion. Okay? Anybody that's a child of anybody that's a member of that American Legion can apply for a scholarship. It's all said and done. They write myself a check for $1,000 directly to me. Didn't write it to the institution, didn't pay it for there, gave it to me, scholarship. So what do you think that scholarship is? It's income, isn't it? Okay?
But then when you get that, can you then claim it that you paid that for your son?
Yes,
Your son's
but how was it paid to me first? I'd much rather have that American Legion give it to the school, because then it went through there. Then it shows that I paid it for it. But if it was paid directly to me,
Right, then it's income, but then you write it off as a.
part of the credit, yes.
Okay.
Yeah. So yeah, you can get it, with your education credit. But again, we're only at a $4,000 limit. Okay? Like I said, if you can find those institutions that are less than $4,000. All right? And room and board does not count, neither does transportation. Okay? So if your son or daughter has to take the bus to go to NCCC, that's not qualified education expenses, even though that's what it's for. All right? Okay? Now, down at the bottom, we got the lifetime learning credit. Okay? So if you don't qualify for this, we can head down here. All right? Same things apply. There's limitations on it, but all the rules apply. But if we look at our little chart on 1324, we can get up to $2,000 credit. Phase out on this one, though, is much less. You can see $130,000. So probably down to $110,000 is when our light starts to get dim. Okay? All right, the other thing is type of program required. Student does not need to be pursuing a program leading to a degree. Okay?
So does this class count?
What's that?
Does this class count?
For the lifetime learning credit? You could. Okay?
An extra dime in there.
I don't know that the credit would round to $1. Yes, I did exactly. Okay? All right. Okay? All right. No, we're not going to be giving you a 1098-T to claim on your tax return. Okay? All right, so that's a lifetime learning credit. All right, so it is strictly non-refundable. Okay? So on page 1330, basically we have our form in a flow chart. Okay? So it talks about each one of these and what we can claim. All right. Okay, does everybody kind of get the education credit? So we have the American Opportunity that's in there for post-secondary, number of years. That starts on 1333. All right. Okay. On the top of 1338, we see the 1098-T, okay? This is when I was talking about all the boxes in there. Box 1 states that payments received for qualified tuition-related expenses, all right? That is what actually was paid. A lot of times, and it drives me absolutely bonkers, okay, is that you'll see it in box 2. What's that box 2 say? Amounts billed, all right? 1098-Ts, apparently the business departments and the accounting departments at these universities is not helping them, okay? So, that being said, the best source for you to determine when the money was flowing is a statement of student account. So they can go on to their little portal where they get their financial package and print out what looks like a bank statement for what was paid and how it was paid. That's the best way to see it. Because what you have to do is for box 1, you have to subtract box 5 and see if any of that is over $4,000. Okay? So if I'm going to Canisius at $35,000 a year for qualified expenses, but I have $33,000 in box 5 for scholarships and grants, how much do I get to put on my American Opportunity? $2,000. Okay? So you can see how important that 1098T is. So you subtract 5 from 1. All right? And that's sometimes where box 5 is probably incorrect, because sometimes I've seen where they've had student loans in the scholarships. Student loan is not a scholarship. Okay? So Fred's wrinkling his brow thinking, oh, why don't they just give you the right information and you can go on? Like I said, most of the time for everybody, I just have taught them that they need that statement of student account, because you can see it. Tuition bill, fall semester 2016. You know, Pell Grant, you know, Stafford loans, you know, whatever. You see it right there. These little boxes and these 1098Ts are never accurate, okay? The other 2 boxes that are important is the bottom ones. Check if at least half-time student, okay? For the American Opportunity, we need to have that check that they're enrolled in pursuing a degree by taking at least half of a class load, all right? And then the other one is checked, is 9, checked if graduate student, okay? If you're in graduate school, you're not eligible for the American Opportunity credit. And trust me, if you're in graduate school, you're not eligible for a whole lot of money. You better hope you have an employer that's helping you pay for your tuition, because grad school doesn't have a lot of opportunities, okay? One thing I do tell my clients, and I direct them to, how many of you guys have ever heard of fastweb.com? Anybody know what fastweb.com is? All right. It is a scholarship site. Val must be going to go to college. Boy, did he grab his pen in a hurry. Okay. All right. Fastweb.com. It is basically a website that has a bunch of businesses and different organizations that are looking for tax write-offs by giving scholarships. All right. Example, my oldest son, he played college football. When he graduated from high school and started college, he was 6'8" and 325. Okay. All right. By the time he was playing, and they beefed him up a little bit in college, he was at 360. So I guess they felt like he needed to put some weight on. Okay. On fastweb.com, there is a scholarship, $500 a semester. The only prerequisite is you had to be at least 6'6". All I had to have was a validated physical from his doctor. All right. No grades, no essay, no transcript, nothing. Just a validated thing. Okay. I still get emails about them. There was one that came across. They were having a contest. $10,000 a year for 4 years. All you had to do was create a YouTube video and post it by a certain date. Okay, and give them the information on it about not texting and driving. If your YouTube video ended up in the top 10 number of views, you got a $10,000 scholarship. Tim's going, okay? All right. If your great-grandmother was a member of the Daughters of the American Revolution, okay? All right. You can click on it, go in there, and you just got to prove it. No grades, no essay, no transcript.
Isn't one on there for like if you're part, or if you're certain amount like Native American?
Mm-hmm.
Is that okay?
Yeah. Yeah.
So I know my daughter's looked into that.
Yeah. It's gotten better in recent years. This scholarship website, there was another one that you had to kind of go through a little biographical thing. And if when you got done, you were a 19-year-old white male, there was no scholarships on the website. Because that wasn't where everybody wanted to give their money, was a 19-year-old white male going to college, which is sad. So, all right. But yeah, even your ethnic origin or your gender, there's scholarships on there. Now, if not everybody is the size of my son, there is a scholarship if you are below 5'6" and you can prove it. You get $500 a year. So you have to decide what you want to do with your child. Put a brick on their head or put them in the rack. Because you got to figure out which one, okay? So you can get them some scholarship money, all right? But great thing to tell your clients. Hey, go to FastWeb. You never know. Those scholarships are out there, okay? All right, lifetime learning credit, 1344. We talked about it. Again, that is only a non-refundable credit. It only is going to eat up our tax bill, and once it's gone, okay? We talk about the qualified education expenses, all right, and everything that we have there. All right. It is one that the number of years, if you have a child that is in the 8-year plan to get their 4-year degree, you can still get the lifetime learning credit after the American Opportunity. So you have that option to pursue that. All right. We talked about on 1347, the 1098T. You see an example one filled in there on 1348 with your problems. All right. And again, credit limit. Understand that this is something that phases out. That's where you will see a lot of times individuals with higher income. That's where you'll start to see them doing a 529. Okay? Because it's like contributing to a retirement account. Because they know they're not going to get the education credit, so somebody's smart enough to have them put money into a college planning the New York 529 plan, so you can get some reduction of taxable income at least. Okay? All right?
So if you have that 529 plan, you may not get the credit?
No, you can still get the credit. The credit's based on your expenses that you paid. The 529 is something that helps you lower taxable income maybe in the years leading up. Okay? Helped a gentleman yesterday with his tax return because he was terribly concerned. He was taking extra money out of a retirement account. And one of the first things I noticed is that he was contributing to a 529 on the state side for his grandchildren. It was a great way for him to lower his taxable income. You know, the household income between husband and wife was well over $160,000, but they still paid no tax in New York because of the way they were contributing things. Okay? All right? Both retired. But, you know, again, at $160,000, if they had a college student on theirs, phased out. The light bulb's gone out. Okay? Okay. Now, on 1353, it talks briefly there about reporting taxable scholarship income. A scholarship is generally an amount paid or allowed to a student at an educational institution for the purpose of study. A fellowship is generally an amount paid to an individual for the purpose of research. If the taxpayer receives a scholarship or fellowship grant, all or part of the amounts received may be tax-free. Qualified scholarships and fellowship grants are treated as tax-free amounts if the following conditions are met. So the recipient is a candidate for a degree in an educational institution that maintains regular facility, curriculum, so and so, okay? Amounts received as a scholarship or fellowship grant are used for tuition and fees required for enrollment or attendance at the educational institution or for fees, books, supplies, and such, okay? So basically what this is saying is if I get a scholarship over and above that, it's kind of like it's paid to me and it's just helping me live, pay my rent. What do you think? If I'm getting a check back from the school over and above, so the money basically flowed through the university to me. Yeah. Yep. Yeah, so that's where scholarships and grants and stuff like that, okay? But what if that money was coming to me, there was excess because I took out excess student loans so that I'd have money to live on?
Wouldn't you consider that as if it was a home loan?
Yeah. Yeah, so if I'm taking out, you know, my student loans are $5,000 to cover my tuition, but I decide to take a student loan out of $10,000, that's not really, I have to pay that money back. So even though I might get an excess check back from the university because I got too much money coming in, and that money's coming back to me and I know it's coming back to me to pay, but it's part of student loans that were kind of funneled through the university. Okay? That make sense?
Kind of like a refund fund?
Yeah, almost like a refund. But If that money is used for living expenses, can I claim it as qualified education expenses? No. Okay, so that's why I say statement of student account is so important. Because you may see on there that they got a check issued to them for the excess. You kind of have to ask where it came from, what it is, and what it was used for. Okay? All right? Okay, so we just covered 57 pages and, all right? Okay? All that reading that you did, you're going, okay? All right? So we covered all the credits. And again, we talked about, and that's why we broke it into 2 sessions. We have the refundable. All right. Broken into 2 sections. Because we basically just got only through the first 3. All right. We're going to start talking about the other ones here. Retirement, child tax credit, residential energy credit. There's some on this line that will fill in here on different things. Okay. So you can see 2, 3, 4, 5, 6, 7 lines. 2 chapters. Okay. All right. Okay. Any questions on those credits? I know there's a lot of information in there that sounds like it's if A, then B, then C, but if A, not B, then it's D. Okay, so you have to make sure on those. Have to make sure on those that you understand where the money and how they qualify. Okay? Because we talked about the foreign credit. Yeah, whole bunch of stuff there in that chapter. But basically, less than $600, we put it right in there. Dependent care. Who's it for? Who's on the return? And what portion of it was out of my pocket? Okay, and there's limitations. Education credit. Who's it for? Are they on my return? Was it for qualified expenses? All right. And are they a felon? Okay. If not, then I have a chance on lifetime learning. Now there's one more education credit that does exist too. That is the tuition credit. It's a adjustment to income. We'll cover it later. Okay. It's not really credit. It's an adjustment to income. All right. Okay. Any questions? No? Speak now or forever hold your peace. No? Okay. What we're going to do is if you have problem, the spinners, okay? It was problem 17.3, the spinners, okay? All right, so if you got 17.3, I want you to go to page 225. There's a tuition statement, and there's also one on 227. All right? So 225 and 227. One is for Joanna Spinner, and the other one is for David Spinner. Okay? I want you to put those 2 in. All right? Because obviously if I'm assigning them, they must be each